Superannuation in Australia refers to the arrangements people make in Australia to accumulate funds to provide them with income in retirement. Superannuation in Australia is encouraged by the government and supported with tax benefits. The government has set minimum standards for contributions for employees as well as for the management of superannuation funds. Employers are required to make superannuation contributions for their employees on top of the employees' wages and salaries. The employer contribution rate has been 9.5% since the 1st of July 2014, and is planned to increase gradually from 2021 to 12% in 2025. People are also encouraged to supplement compulsory superannuation contributions with voluntary contributions, including diverting the wages or salary income into superannuation contributions under so-called salary sacrifice arrangements. An individual can withdraw funds out of a superannuation fund when the person meets one of the conditions of release contained in Schedule 1 of the Superannuation Industry Regulations 1994. As of the 30th of June 2015, Australians have over AUD $2.02 trillion in superannuation assets. Though the main purpose of the superannuation scheme in Australia has been and continues to be to create an environment in which people can put funds aside to provide an income in retirement, the tax incentives available have also come to be used, especially by wealthy individuals, as a tax-effective saving strategy. As a consequence, the government has set limits on the amounts that can be brought into the scheme at concessional rates with a number of caps. Amounts above those caps can still be brought into the superannuation scheme but are generally taxed at the top marginal tax rate. Compulsory superannuation in combination with buoyant economic growth has turned Australia into a shareholder society, where most workers are now at least indirect investors in the stock market. Consequently, a lively personal investment marketplace has developed, and many Australians take an interest in investment topics. Introduction. Before 1976, superannuation arrangements had been in place for many years under industrial awards negotiated by the union movement. A change to superannuation arrangements came about through a tripartite agreement between the government, employers and the trade unions. In the Prices and Incomes Accord of 1983, the trade unions agreed to forego a national 3% pay increase which would be put into the new superannuation system for all employees in Australia. This was matched by employers' contributions. Since its introduction, employers have been required to make compulsory contributions to superannuation on behalf of most of their employees. This contribution was originally set at 3% of the employee's income and has been gradually increased by the Australian government, though there is general widespread support for compulsory superannuation today. At the time of its introduction, it was met with strong resistance by small business groups who were fearful of the burden associated with its implementation and its ongoing costs. In 1992, the Keating Labour government introduced a compulsory superannuation guarantee system as part of a major reform package addressing Australia's retirement income policies. It is a scheme of compulsory superannuation contributions made by employers on behalf of their employees. It was calculated that Australia, along with many other Western nations, would experience a major demographic shift in the coming decades of the aging of the population, resulting in the anticipated increase in age pension payments, placing an unaffordable strain on the Australian economy. The proposed solution was a three-pillars approach to retirement income, a safety net consisting of a means-tested government age pension, private savings generated through compulsory contributions to superannuation, voluntary savings through superannuation and other investments. Since the 1st of July 2002, the minimum contribution has been set based on an employee's ordinary time earnings and is thus not payable on overtime rates. It is payable on remuneration items such as bonuses, commissions, shift loading and casual loadings. Minimum employer contributions have since the 1st of July 2014 been 9.5% of employee wages, and after the 30th of June 2021 the rate is planned to increase by 0.5% each year until it reaches 12% by 2025. Operation Employer contributions. Compulsory employer superannuation contributions are called superannuation guarantee contributions. These amounts must be paid to a designated superannuation fund for their employees at 9.5% of the wages and salaries. Employers are not required to make employer contributions for employees earning less than $450 per month, nor for employees aged under 18. If, however, employees are earning $450 per month before tax or aged under 18 but working more than 30 hours per week full-time, part-time or casual, the employer is required to pay superannuation regardless of whether the person is under 18. Additionally, if employees aged over 70 years pass the work test and work more than 40 hours in a 30-day period, the employer can still pay contributions. They are also required to complete one per tax year. Employer contributions are required to be paid to a fund at least every 3 months. For the period 1993 to 1996, there was a higher contribution rate for employers whose annual national payroll for the base year exceeds $1 million, with the employer's minimum superannuation contribution percentage the subsequent year, which is outlined in the above table with an asterisk. The SG rate was supposed to increase on the 1st of July 2014 to 9.5% and to 10% from the 1st of July 2018, and then increase by 0.5% each year until it reached 12% on the 1st of July 2022. The 2014 federal budget deferred the proposed SG rate increase to 10.0% for 3 years, with the SG rate now to remain at 9.5% for 7 years, until the 30th of June 2021, and then increase by 0.5% each following year until the SG reached 12% on the 1st of July 2025. The superannuation contributions are invested over the period of the employee's working life, and the sum of compulsory and voluntary contributions, plus earnings, less taxes and fees, are paid to the person when they choose to retire. The sum most people receive is predominantly made up of compulsory employer contributions. Special rules apply in relation to employers providing defined benefit arrangements. There are less common traditional employer funds where benefits are determined by a formula usually based on final average salary and length of service. Essentially, instead of minimum contributions, employers need to provide a minimum level of benefit. Salary sacrifices contributions. With the agreement of an employee, employees may request that their employer makes all or part of future payments of wages or salaries into superannuation in lieu of making payment to the employee. Such arrangements are known as salary sacrifices, and for income tax purposes are treated as employer contributions. They're not subject to the superannuation guarantee rules, are not part of taxable income of the employee. Officially, such contributions are called reportable superannuation contributions, and for some purposes they are counted back as income of the employee. To be valid, a salary sacrifice arrangement must be agreed between employer and employee before the work is performed. This agreement is usually documented in writing to evidence the agreed arrangement. Personal contributions. People can choose to make extra voluntary contributions to the superannuation and receive tax benefits for doing so. However, the current superannuation legislation states that individuals who contribute more than what is allowed under the annual superannuation concessional contributions cap must pay the superannuation excess concessional contributions tax, which is set at 31.5%. Access to superannuation. As superannuation is money invested for a person's retirement, strict government rules prevent early access to preserved benefits except in very limited and restricted circumstances, including severe financial hardship or on compassionate grounds, such as for medical treatment not available through Medicare. Generally, superannuation benefits fall into three categories: preserved benefits, restricted non-preserved benefits, and unrestricted non-preserved benefits. Preserved benefits are benefits that must be retained in a superannuation fund until the employee's preservation age. Currently, all workers must wait until they are at least 55 before they may access these funds. The actual preservation age varies depending on the date of birth of the employee. All contributions made after the 1st of July 1999 fall into this category. Restricted non-preserved benefits, although not preserved, cannot be accessed until an employee meets a condition of release, such as terminating their employment in an employer superannuation scheme. Unrestricted non-preserved benefits do not require the fulfillment of a condition of release, and may be accessed upon the request of the worker. For example, where a worker has previously satisfied a condition of release and decided not to access the money in the superannuation fund. Preservation age. Eligibility for access to preserved benefits depends on a worker's preservation age. The Howard government announced changes in 1997 to the superannuation system designed to induce Australians to stay in the workforce for a longer period of time, delaying the effect of population aging. Previously, any Australian could access the preserved benefits once they reached 55 years of age. However, after legislation was passed in 1999, an employee's preservation age depends on the date of birth. Hence, by 2025, all Australian workers wishing to access the superannuation would be at least 60 years old. Once a person reaches preservation age, they must also meet a condition of release to access the super. Before age 60, workers must cease employment and sign off that they never intend to work again. Those aged 60 to 65 can access super if they cease employment regardless of the future employment intentions, so long as they are not working at the time. Anyone over age 65 can access super regardless of employment status. Employed individuals who have reached preservation but are under age 65 may still access up to 10% of the super using a transition to retirement pension. If an Australian worker has transferred funds from the New Zealand KiwiSaver scheme into their Australian superannuation scheme, they cannot access the ex-New Zealand portion of the superannuation until they reach the age of 65, regardless of the preservation age. This rule also applies to New Zealand citizens who have transferred funds from the New Zealand KiwiSaver scheme into an Australian Australian Superannuation Fund. Reasonable benefit limits. Reasonable benefit limits were the maximum amount of retirement and termination of employment benefits that a person could receive over their lifetime at concessional tax rates. RBLs were abolished from the 1st of July 2007. There were two types of RBLs, a lump sum RBL and a higher pension RBL. The lump sum RBL applied to most people. Generally, the higher pension RBL applied to people who took 50% or more of the benefits in the form of pensions or annuities that met certain conditions. Each year, RBLs were indexed according to movement in average weekly ordinary time earnings published by the Australian Bureau of Statistics. For the financial year ending the 30th of June 2005, the lump sum RBL was $619,223 and the pension RBL was $1,238,440. Superannuation tax is contributions made to superannuation, either by an individual or on behalf of an individual, are taxed differently depending on whether that contribution was made from pre-tax or post-tax money. Pre-tax contributions are contributions on which no income tax has been paid at time of contribution, and are also known as before-tax contributions or as concessional contributions. They comprise mainly compulsory employer SG contributions and additional salaries sacrifice contributions. These contributions are taxed by the superannuation fund at a contributions tax rate of 15%, which is regarded as concessional rate. For individuals who earn more than $300,000, the contributions tax is levied at 30%. Post-tax contributions are also referred to as after-tax contributions, non-concessional contributions, or as undeducted contributions. These contributions are made from money on which income tax or contributions tax has already been paid, and typically no further tax is required to be withheld from the contribution when it is made to a fund. Both contribution types are subject to annual caps. Where the annual cap is exceeded, additional tax is payable either at the marginal tax rate for concessional contributions, or an additional 31.5% for non-concessional contributions, which is in addition to the standard tax rate of 15% payable on contributions, making a total of 46.5%. Investments in the fund. Investment earnings of the superannuation fund are taxed at a flat rate of 15% by the superannuation fund. In addition, where an investment is sold, capital gains tax is payable by the superannuation fund at 15%, much like the discount available to individuals and other trusts. A superannuation fund can claim a capital gains tax discount where the investment has been owned for at least 12 months. The discount applicable to superannuation fund is 33%, reducing the effective capital gains tax from 15% to 10%. These taxes contribute over $6 billion in annual government revenue. Superannuation is a tax-advantaged method of saving as the 15% tax rate on contributions is lower than the rate an employee would have paid if they received the money as income. The federal government announced in its 2006-07 budget that from the 1st of July 2007, Australians over the age of 60 will face no taxes on withdrawing monies out of the superannuation fund if it is from a tax source. Discontinued surcharge tax. In 1996, the federal government imposed a superannuation surcharge on higher income earners as a temporary revenue measure. As part of the 2001 election campaign, the government promised to reduce the surcharge from 15% to 10.5% over 3 years. The superannuation surcharge was abolished in the 2005-06 budget, effective from the 1st of July 2005. Superannuation Co-Contribution Scheme. For the 1st of July 2003, the government has made available incentives of a government co-contribution of up to $1,500 for lower-income employees who make personal contributions to their own superannuation fund. Depending on individual income thresholds, the government paid up to $1.50 for every $1 personal contributions made. The 2007 federal budget announced a one-off double payment of the co-contributions paid due to personal contributions in the 2005-2006 financial year. Lower-income earners received up to $3,000 co-contribution for $1,000 of personal contributions in that year. The amount has since been lowered to a matching contribution to a maximum of $1,000, up to and including FY 2012. For the 2012-2013 financial year, the co-contribution was reduced to 50% of personal contributions, to a maximum of $500. Effect on taxable income and age pensions. Income tax. The reason that people invest in superannuation is to reduce their income tax liability and possibly to be able to receive an age pension while still receiving supplementary income. Compulsory employer contributions are taxed at the concessional rate of 15% or more for higher income earners. People may choose to make additional payments at the same rate as salary sacrifices, but only if their employer agrees to do so. Additional payments made without the cooperation of an employer are taxed at full income tax rates and are subject to different rules. Income earned in the fund is also taxed at 15%, depending on circumstances. Income retrieved from the fund after preservation age is generally tax-free. Tax Office. The full details are extremely complex. Pensions. Australian citizens and residents over 67 years of age are entitled to an age pension if their income and assets are below specified levels. The full pension, as at 2014, was $766 every 2 weeks for singles and $577.40 each for couples. This reduced by 50% of any income over $160 every 2 weeks for singles at $284 for couples. The pension may also be reduced for 0.15% of assets other than the home over $202,000 at $286,500 for single or couples. The pension is reduced by the maximum of the income and assets test. Assets may also be deemed to earn between 2% and 3%, which is counted towards the income TED. Income received from a superannuation fund is considered to be income for pension purposes, and reduces the pension by 50% of the income received that is over the limit. However, if this is received as a super pension, then the effect on the age pension is discounted by the cost of the super pension. This cost is calculated by dividing the total super balance by the life expectancy of the receiver at the time the super pension began. This means that if one withdraws one's super evenly over one's expected life expectancy, there is essentially no income test on it. Assets in a pension fund are deemed to earn income. The assets supporting a super pension are also deemed to earn income. Superannuation funds. Trustee structure. Superannuation funds operate as trusts, with trustees being responsible for the prudential operation of the funds and in formulating and implementing an investment strategy. Some specific duties and obligations are codified in the Superannuation Industry Act 1993. Other obligations are the subject of general trust law. Trustees are liable under law for breaches of obligations. Superannuation trustees have, inter alia, an obligation to ensure that superannuation monies are invested prudently with consideration given to diversification and liquidity. Investments, other than a few very specific provisions in the Superannuation Industry Act 1993, funds are not subject to any asset requirements or investment exposure floors. There are no minimum rate of return requirements, nor a government guarantee of benefits. There are some minor restrictions on borrowing and the use of derivatives and investments in the shares and property of employer-sponsors of funds. As a result, superannuation funds tend to invest in a wide variety of assets with a mix of duration and risk-return characteristics. The recent investment performance of superannuation funds compares favorably with alternative assets such as 10-year bonds. Types of superannuation funds. There are about 500 superannuation funds operating in Australia. Of those, 362 have assets totaling greater than $50 million. Superannuation assets total $2.05 trillion at the end of the March 2015 quarter, a new record according to the Association of Superannuation Funds of Australia. There are 7 main types of superannuation funds. Industry funds are multi-employer funds run by employer associations and/or unions. Unlike retail, wholesale funds, they are run solely for the benefit of members, as there are no shareholders. Wholesale master trusts are multi-employer funds run by financial institutions for groups of employees. These are also classified as retail funds by APRA. Retail master trusts, RAP, platforms are funds run by financial institutions for individuals. Employer standalone funds are funds established by employers for their employees. Each fund has its own trust structure that is not necessarily shared by other employers. Self-managed superannuation funds are funds established for a small number of individuals and regulated by the Australian Taxation Office. Generally the trustees of the fund members. The Smsf sector is the largest of the Australian super industry, with 99% of the number of funds and 31% of the $1.6 trillion total super assets as at the 30th of June 2013. Recent changes to the SIS Act has allowed SMSFs to borrow under limited recourse borrowing rules. Banks have now developed SMSF loans catering purely for this change to the Act and to enable SMSFs to borrow for residential property, commercial property and industrial property. However, funds cannot acquire vacant land. There are restrictions placed upon the fund that the trustees of the fund cannot gain a personal advantage from asset acquired by the fund, or purchase from what's known as a related party. For example, you would not be able to live in the home that is owned by your SMSF. SMSF loans are generally available to 70% to 80% of the purchase price and attract a slight margin to the interest rate in comparison to standard loans. SMSF property investment has gained considerable momentum since the amendment of borrowing provisions to allow for the purchase of residential real estate. The ability to obtain a limited recourse loan to buy income-producing property in a favorably low-tax environment has affected a rapidly emerging incidence of direct property investment within SMSF structures in recent times. Small APRA funds are funds established for a small number of individuals, but unlike SMSFs, the trustee is an approved trustee, not the member per second, and the funds are regulated by APRA. This structure is often used for members who want control of the superannuation investments but are unable or unwilling to meet the requirements of trusteeship of an SMSF. Public sector employees' funds are funds established by governments for their employees. Retail and wholesale master trusts are the largest sector of the Australian superannuation market. Choice of superannuation funds. For the 1st of July 2005, many Australian employees have been able to choose the fund their employer's future superannuation guarantee contributions are paid into. Employees may change a superannuation funds to one when their current fund is not available with a new employer. Consolidate superannuation accounts to cut costs and paperwork. A lower fee and/or better service superannuation fund, or a better performing superannuation fund. Where an employee has not elected to choose their own fund, employers must since the 1st of January 2014 make default contributions only into an authorized MySuper product, which is designed to be a simple superannuation fund with few standardized fees and a single balanced investment option.